Trend lines are a staple for technical traders, so I want to spend the duration of this video looking at a couple of techniques for using trend lines to help you assess the strength or weakness of a trend, and exactly how to find trends on multiple time frames. Now, the classic phrases, "the trend is your friend" and "trade with the trend" may sound extremely cliche, but they often are the case. When trading trend lines, traders typically tend to look to buy at bullish support lines and sell at bearish resistance lines. In other words, trade with the trend. The idea is to find the most obvious trending moves you can find and look for those trades in those environments. The first step to take when looking for a trade is to determine the trend of the market, as this will determine your trading bias. If we take a look at this chart as an example, you will see that we are in an uptrend, a bullish market, which means the price has been trending up. This is typically when many traders tend to look out for buying opportunities. Conversely, if we are in a downtrend, which is a bearish market, the price has been trending down and traders tend to look for selling opportunities. Now, if the market is range bound, where you are noticing a sideways trend, trading is limited between similar price levels, you might look to buy above the lows, or support level, and potentially sell below the highs, or resistance level. Trading in the direction of the trend may help you when looking to trade potential trendline bounces. Of course, while it won't guarantee you winning trades, it may potentially help you gain more pips than had you been attempting to place trades against the trend. Now, if you are unsure of the asset's current trend, move on to the next one where the trend is actually more obvious. Remember, commonly, an uptrend, for example, only changes to a downtrend when the market trades through the previous low. A downtrend is perceived as changing to an uptrend when the market trades through the previous high. Now, as I said earlier, drawing trend lines is a powerful tool traders use to help time entries and exits of a trade, and can be used in combination with other tools you might already be using. However, one of the classic mistakes new traders often tend to make is trying to make the line fit the market instead of the other way around. Now, technically speaking, a trend line is perceived as a line connecting two or more lows or highs with lines projected out into the future. Traders then tend to look at these extended lines and oftentimes choose to trade on prices reacting around them. A few things to remember when drawing and using trend lines are: only draw unbroken trend lines. Don't draw a trend line where the prices broke through the line being drawn, as this does in fact invalidate the trend line. For a trend line to be valid, the two swing lows need to be connected together by a line unbroken by price, so it should not go through any candlestick bodies. Only then can it be used as a projection into the future. Remember, the point of using trend lines is so that the next time the price gets near this trend line, we will want to look for a bounce. Another important point to consider is just because you draw a line connecting any 2 points on a chart, it doesn't actually mean the line is a valid trend line. What you actually have is a potential trend line. To truly validate a trend line, you need to see the price actually react from a line projected from a trend line drawn based off 2 prior points. Essentially, a third high or low is needed to truly solidify a trend line. Once you then have this, you can then feel better about looking for opportunities to exploit the market when the price reaches the trend line again. Traders often believe that the more times the trend line has been hit and respected with a bounce, the stronger the market sentiment. Now, this is because each time you see the price bounce off the same line, the more likely it is that other traders are watching it too. This could help you with potential entry points, but remember, trend lines won't last forever, so you want to make sure you set your proper stop losses to get you out quickly if the support or resistance trend line eventually fails. So we've already discussed how important it is to learn how to identify an underlying trend and trade around it accordingly. Next, it's useful to learn how to find trends on multiple time frames, as using multiple time frame analysis can drastically improve the odds of making a successful trade. Sometimes, new traders get caught up in looking into a small period of time without getting a real good feel for the mood of the market. In other words, it is important to step back in order to look at the bigger picture. For example, If we take a look at this chart, when looking at a smaller time frame, you can see that it looks like we are in a downtrend. However, if we take a step back and look at the bigger picture, when looking at a daily chart, we can see that the strong downtrend we describe in the shorter time frame is actually in fact a strong uptrend. In longer time frame, for example, will show that although the price pair has moved down for some time, it is clear to see that it quickly ran out of steam, reversed course, and continued on its long-term upward trend. So if you don't want to get caught up on the wrong side of the trade, it's important to get used to using and analysing more than one time frame when you're seeking out trading opportunities using trend lines. A general rule is that the longer the time frame, the more reliable the signal is being given. Ideally, that is why it is a good idea to look at a longer time chart to determine the trend, and then move down to the shorter term time frame chart to find a trend in the direction of the longer term time frame. At the other end of the spectrum, the short term time frame will help you see clearer the smaller fluctuations in price action. What group of time frames you decide to use is an individual choice. However, it is important to select the correct time frame when choosing the range of the 3 periods. For example, if you're a day trader and you usually hold your positions for a few hours but less than a day, you may find little advantage in using a daily, weekly and monthly setup. The same goes for a long-term position trader. They might find little use for a 15-minute, 60-minute and a 4-hour combination. Now you know how to identify trends and use multiple time frames. Practice applying these concepts to your trading.